Let's start the program with this week's inflation rate, which did come in higher than expected. For most economists, it was a last piece in the puzzle about what the Reserve Bank will do next with interest rates. From those economists, the picture is now clear. Rate rises must recommence. Edward Boyd starts our coverage.
Without further ado, please join me in welcoming the new Governor of the Reserve Bank of Australia, Michelle Bullock.
On Tuesday, Reserve Bank Governor Michelle Bullock spoke for the first time since being promoted to the new job. She was clearly determined to send a strong message about the RBA's willingness to fight inflation. Economists call it hawkish.
The board won't hesitate to raise the cash rate further if there's a material upward revision to the outlook for inflation. We're going to reconsider the outlook for the economy in the light of incoming information.
The problem was, the next day, inflation surprised to the upside, 5.4%. The market expected less. It prompted most economists to immediately change their economic forecasts. After previously saying the cash rate would be on hold in November, now almost everyone said the RBA will hike on Melbourne Cup Day. CBA wrote, CPI stronger than expected, RBA to hike the cash rate in November. ANZ said, RBA to hike in November, Q3 CPI too high to risk holding. And NAB was the strongest in their analysis, saying RBA to hike in November with risk of another.
Markets are pricing about 38 points of, if you like, so 1.5 rate rises. Our view would be it's more likely, unless inflation stays even higher than what we expect, that they'll do one and then sit there and watch. And probably what will happen is that you won't now see rate cuts until the back end of the year rather than the middle of the year. So higher for longer, if I can put it that way.
But one person didn't see it that way. Treasurer Jim Chalmers downplayed the stubbornly high inflation number. He said markets can be wrong, that he couldn't talk for the Reserve Bank, but we shouldn't assume rate rises.
It's really important to recognise that the annual inflation number that we have received today is in line with expectations. It's in line with the Treasury forecasts in the most recent budget, and it doesn't materially change. It doesn't change the Treasury's expectations for when inflation will return to the target band.
Chalmers, it was clear, was seeking to talk the market around. So how would Bullock react? The next morning, she fronted Senate estimates in Canberra and was asked multiple times about inflation. Every one of her answers was circumspect. Not that she would ever give too much away, but the inflation-fighting hawk from 2 days earlier now seemed more dovish.
The print came out a little higher than we'd been forecasting at our August statement on monetary policy, but it was pretty much where we thought it would come out, given the information we'd come into since then, particularly the monthly CPI indicator. So we thought it was going to be about where it came out. Inflation
is higher than the RBA's forecasts due to higher fuel prices and sticky services costs. But Bullock could not be drawn about whether rates will rise.
I'd say we're still analysing the numbers at the moment. I wouldn't like to say more or less likely. We're still looking at it. It has confirmed what we've been saying all along, as I said, that the persistence is in the services side and the goods side is responding, but I think that's all I'd say at this point. All I was trying to convey really was the same thing we've been conveying all along, which is the longer that inflation remains outside the target band, the more likely it is that inflation expectations might adjust to that.
After her Senate appearance, Bullock's old colleague, Lucy Ellis, the former head of economics at the RBA, emerged and said rates will need to rise. Ellis joined Westpac as a chief economist 3 weeks ago. Until this week, she's been silent on the direction of rates. So her research note is a critical signal from someone who knows the RBA and its Monetary Policy Board so intimately. Ellis wrote, having spelled out so clearly that a material surprise to the outlook would warrant a rate increase, she simply had to be equivocal to avoid front-running the board's decision, which is still more than a week away. An increase in November won't be the outcome the RBA had hoped for, but given the strength of their rhetoric around upside surprises, I don't think they will try to craft a rates-on-hold story. nor will they wait until the following month. On Thursday, the ASX rate tracker was pricing in a 55% chance of a rate increase next month. But on Friday, shifted down to 47% after Bullock's comments in the Senate. The key factor influencing rates is trimmed mean inflation. It remains elevated at 5.2%, too high for comfort, perhaps. Prices for petrol, rents, electricity, gas and takeaway food were all higher than the previous quarter. Some of those are expected to still be rising now.
What the Reserve Bank looks at is the trim mean. So they sort of trim away the bottom 15% of price falls, take away the top 15% and look at the average. Now, the Reserve Bank was expecting 0.9 in the quarter and they got 1.2. So you never know exactly what the Reserve's going to do, but they've said essentially that if they got a surprise on the upside on inflation, they would essentially react to it.
But as politics crashed into the monetary policy debate this week, Shadow Treasurer Angus Taylor was more direct.
Australians are feeling the pain from these price rises. So in the last quarter alone, a 1.2% increase. That's well above what it was in the previous quarter, 0.8, and well above expectations. And of course, that increases the probability of a Reserve Bank interest rate increase in the future.
The next RBA board meeting is on Melbourne Cup Day. This week's information makes it clear. The meeting is live. Rates could rise again.
Well, the wild card for our economy right now is the Aussie consumer and their spending resilience in the face of rising prices and interest rates. And already there are warning signs. Supermarket grocery basket sizes, they're lower. JB Hi-Fi's quarterly sales, they were down this week. Four-wheel drive accessories company ARB says its business is falling. But in the US in the past quarter, consumer spending drove its economy to a surprising high of 4.9%. And all this plays into the Reserve Bank's decisions. Well, this week I spoke with Micaela Fuchila, Head of Australia and New Zealand Economics at Bank of America, about the resilience of Australian consumers.
We have an inbuilt measure of household spending, which looks at what the consumer is going to be in the next quarter. And this is the first time that index actually has dropped into the negative level. So the ABS data is actually showing that consumption is at the same levels that we have seen during the pandemic when the economy was in lockdown. If you take into account the amount of population growth that we had in the last year, it's actually extremely weak consumption. Measures of discretionary spending and essential spending are both declining, suggesting they're really feeling the interest rate rises as well as the inflation. So the RBA has really this very difficult balancing act between controlling inflation and also making sure that consumers can get through the end of the year at least.
OK, so we can see your chart here. And what it's really showing us in many ways is that there has just been a significant drop-off, which means that the rise in interest rates from the Reserve Bank's point of view has actually done its job.
Yes, I would agree with that. We're also going through what we call the mortgage cliff, which is all these fixed mortgages are actually starting to expire, and a lot of people who were on rates around 2 to 3%, they're going to see large increases. Those consumers, based on RBA research, are more prepared for the hikes than those who were on variable rates, but still means that there's a little bit more to go on the consumer side of things. Our team, our banking team, is estimating that the peak of schedule expiry of those mortgages is December. So the last quarter, as we head into Christmas, is probably going to look like what the chart is
and that's also the same quarter, if we think about where we are right now, given what's happening in the Middle East, that fuel prices are also much higher. Yeah. So you've got energy prices at home, you've got fuel prices, you've got ongoing increases in the cost of housing.
Yes.
And then on top of that, you've still got the potential of at least another interest rate rise. Is it actually necessary, do you think?
I was the idea initially that it wasn't necessary, that the RBA has done enough. But looking at the composition of inflation yesterday, it seems like the right thing to do. So core inflation measures that actually exclude all these volatile items that you mentioned are showing that inflation is still really strong at that level. The RBA has a forecast. They are expecting inflation to reach 4.1 by the end of the year. It's not looking very likely. They have expressed consistently that they will change their forecast. And if there is a material change, they will act on the back of that. So we do expect them to hike the rate 25 basis points. There's two things about it. We don't think there's any more scope to continue hikes, so they will have to really live with inflation above target for a bit longer. They think they will reach the target back at the end of 2025. We think that's achievable. But at the same time, the consumer is a big concern. Consumers are continuing to be very weak, and they really can't handle any more.
Yeah, we can see the inflationary aspects here. And the real problem here, as I can see it, is when you look at transport, health, recreation and housing. These are things that people can't avoid. And yet those prices still continue to be stubbornly high and rising. And that gives the sense, which even Michelle Bullock has spoken about in the past week or so, about the sticky inflation, the fact that it's really not, sometimes the Treasurer says, imported inflation through goods prices. This is now going to the services industry.
Yeah, so the transport part, it is petrol prices mostly, and also travel, domestic travel. It's been impacted by all of those. All of these are also inputs into companies' prices as well. Electricity going up, services in the household sector. The services side of things is different. It's more driven by demand. So demand for consumers is slowing. So you would expect that services is going to start to come down as the economy and demand slows. The last quarter data actually showed a decrease in services, but it was actually driven by childcare fees. That was impacted by a policy from the government where the childcare fees actually declined. Other than that, the services side is still really sticky, and rents is probably one of the main drivers there, recording ongoing increases. And
OK, so there's one other aspect of this, and that is, you know what the thinking of the Reserve Bank Board will be. There's history whereby central banks, in Australia particularly, have one or two interest rate rises they probably in hindsight should not have had. They literally keep raising rates when really the argument is they should have been cutting rates. They're trying to get that balancing act just right to keep more people in jobs. That's the psychology of it. But the numbers, the pure numbers right now are saying you don't have much choice. You've probably got to keep on raising those rates.
Yeah, I guess the RBA has tried so far to keep that balance between employment growth positive, supporting jobs and also supporting inflation and avoiding much larger increase in inflation expectation. Those are things that are really hurtful for incomes in the household sector. What happens there is now the consumer is on the edge. So this extra hike is probably more likely to push the consumer a little bit further, and we might not be able to avoid that soft landing that people are talking about. The financial stability review from the RBA show that the consumer is quite resilient. They are making the payments on their mortgages. They're getting by.
Home prices are going up.
Home prices are going up. So that means the asset values are okay. It means that if you believe in wealth effect, consumer sentiment should probably increase. But it also creates more demand for housing on the investor perspective, considering rents are going up as well. So
tell me one thing. When we look back in history, Micaela, do you think that the Reserve Bank will be compared with its peers overseas, many of which went much harder with interest rates than what they did here in Australia? And we know what that delicate balancing act that they're trying to achieve. But in hindsight, do you think they'll be judged well for that approach as compared with, say, New Zealand, which has gone much harder, hurt their economy, you could argue, more quickly? The United States, gone much harder, now showing signs of it turning around. The UK, a basket case, gone much harder as well. How do you reckon they'll be judged?
I think Australia has significantly different idiosyncratic factors. So the Australian consumer is highly leveraged. It's one of the most leveraged in the world because of housing.
So more sensitive to interest rate moves?
Yes. The second thing is the mortgage sector is a variable rate sector mostly. In the US, mortgages are 30-year fixed. So even if you hike the rate, you're not really hurting consumers as much as you do here. That means the transmission is probably faster in Australia than it is elsewhere. The New Zealand case is different because the economy is a little bit less diverse as Australia. So more the reaction function is different from the central bank, and also income growth was a lot higher than it is here. We haven't really seen the peak on wages growth domestically, whereas in New Zealand we saw wages actually catching up with inflation. So if I take the economy at face value, you could think now the RBA probably hasn't done enough to control inflation, but the drivers of inflation are really things you can't control with interest rates rises. So I can understand why they'll focus more on the consumer and the labour market, considering that they can't control oil prices by hiking rates. They can't control rent prices by hiking rates. So they think there's a lot of more factors going on there. So, yeah, I think in hindsight, we don't think there's more scope to go beyond that 4.35 in November.
I'll tell you what, Micaela Fuchila, it's good to have you on the program. I really appreciate your time, and we'll do it again shortly.
Thank you.